Rohit Agarwal, Executive Vice President and Equity Fund Manager at Kotak Life Insurance Company, joining with us this afternoon. Rohit, a very good afternoon to you. And, I just want to start by talking about Nifty IT. Let's just put that out of the way because after TCS's numbers, nothing exciting coming in there. And that has impacted, when the leaders' numbers are weak, we're seeing that everything else, the full pack is seeing a bit of a decline. The rally that everyone was talking about or waiting for in the Nifty IT seems to be on a halt. How should one be viewing the Nifty IT going forward? Is this trend here to stay for the next few quarters at least?
Hi, good afternoon. Of course, as you said, the start by the bellwether of the index has not been a great one, where the street has seen anywhere between 2 to 3% EPS cuts. We believe that might be a norm, or that is something that others might replicate or even do worse, where I think the street might see again anywhere between 2 to 5% EPS cuts in most of the stocks and a pack as a whole of IT. Having said that, what we believe is, given the softness in near-term demand, there seems to be this view that there is not going to be great traction in IT, where numbers will get cut for the next 2 quarters. The silver lining, though, is that order bookings remain good. So after a couple of quarters or so, when the world at large will start looking at peaking of interest rates and will start thinking about interest rate cuts, I think that is the time there will be some traction that will come back in IT. We have to bear in mind that these companies are cash rich. Operating cash flow to yield, operating yield is pretty high. So at some point, they become a very good bargain buy. And I think after 1 to 3 quarters, there will be a time when IT will be bought very aggressively, because as soon as things change, as soon as the demand changes, the environment changes, people will flock to buy IT because now they are trending towards their long-term averages. The moment the earnings cut stop, I think the things will change. But I think that moment is anywhere close to 2 quarters away, in our opinion.
When IT doesn't do well, you generally tend to see flows coming into bank. Deposit numbers there, growth numbers there are looking in strong, Rohit. Do you think that flows would move towards banks for now?
Historically, they have behaved in such a way where one sector, when it outperforms, the other tends to underperform. At the same time, even though IT numbers will get cut, you will see, at least in India, not any impact on the financial space in terms of numbers. So the reported numbers that we are likely to see, our expectation is that we are not likely to see any earning cuts in the financial space per se. And hence, as you rightly put, we believe that banking in the near term may outperform IT simply because there is earnings traction. And even at the macro front, the Indian macro at least is starting to get better, where you have seen the softening in the CPI. You've also seen trade deficit numbers and Indian macro numbers starting to look better. So the hit on the rupee or the pressure on the rupee because of current account deficit is at the margins starting to recede. So Indian macro is not that bad. The RBI took a pause, suggesting that it is not necessarily a pivot, but it also suggests that they want the interest rate hikes that they have done to seep in. They want to wait and watch. So I think from the numbers perspective, banking is unlikely to disappoint. And when earnings don't disappoint, it is unlikely that stocks disappoint over a larger period of time.
Right. Rohit, the trend in the market, of course, was also that what's happening to rates in the system, what's happening to CPI. Last when we spoke, it was a completely different environment for that. And now with RBI meeting being away, the new CPI data coming in, how would you just look at that? Do you think that is the reason why markets have just stabilized over the last 4-5 days?
Well, we can find reasons and justify why the market has stabilized. I think one of the reasons, as you rightly said, it could be what you said. But I think one of the bigger reasons is that Indian macro is starting to stabilize. So the dark clouds that you earlier saw on the Indian macro, where there was a relentless rise in US interest rates, there was a relentless issue on the US inflation, all of that is starting to recede a bit. And in the Indian context, it's the current account deficit which is starting to give some respite to people, and that has also meant maybe that the RBI has taken a pause. All of that added together means that the home loan rates, which is the biggest barometer that we try and stick to, that whenever home loan rates start to go beyond 9%, they start hurting the economy. Today they are closer to 8 9%, and I think if they stay there for next 3 to 6 months, and then if data improves on the inflation side globally as well as locally, then you start to make some room for cuts of 25 to 50 basis points depending upon the macro, obviously commodities, and then interest rates.
And let's just talk about some bit of a brightness in the markets that we're seeing is coming in from the pharma space. That has been showing some bit of light over there, some brightness. How are you viewing the pharma space? Is that something we should be watching out for going forward?
Well, if you look at the pharma space, it's actually underperformed on a 5 year basis. But pharma is a very unique sector where at any point of time, you will find one stock which is at a 52-week high and another stock which is at a 52-week low. That's very counterintuitive to how a sector behaves. That's because pharma is a sector which is totally and totally bottom up, where one company is not the same as other. So effectively saying that that it is not a homogeneous sector. Pharma is a heterogeneous sector. So you have to always evaluate pharma on a bottom up basis. There will always be stocks. At times, you will want to play India dedicated plays. At times where you believe that US is likely to do well, you would like to play the companies which have more exposure to the US. And suddenly there might be a time that you want to play none of these and you want to play a chronic and acute. So in pharma, we believe that at every point of time, you can be invested. But at the same time, in pharma, at every point of time, you'll find stocks which are overvalued and should never be there. So pharma, it's a small index weight, about 3 odd percent. I think you should always be bottom up in that sector and not try to take a view on the sector per se, because it just doesn't work that way.
How would you look at pharma? Would you play the healthcare space? Would you play India dedicated story? Would you play a API play, a US play? How would you essentially play it right now? Don't you think it's a sector which is completely neglected and there is a lot of value in various names?
There is some value in some names. Currently, as we talk, I think some of the India dedicated plays stand to benefit more, simply because today there is not such visibility in the US market on the pricing and the way they are behaving. But the Indian market, if you look at the Indian domestic market, that continues to grow at 12 odd percent, 10 odd percent. And the Indian pharma, the Indian dedicated players will not find it very difficult to grow at 15 to 17%, especially the larger ones, especially the good India dedicated ones. So currently we believe that the Indian plays offer better value rather than the offshore plays. And within that space, the hospital space, as you mentioned, healthcare space, I think hospital as a space is now getting to a point where they do not look that attractive to us simply because valuations there have re-rated. Now there are a lot of options in the hospital space for someone to invest in. As more and more companies get listed in a space, in any space, the valuation of that space tends to derate because the scarcity factor starts to reduce. You have to always keep that in mind. Ultimately, companies move on what return on capital employed they generate, and it is not necessarily a space which generates a humongous or great 20% ROC on a sustainable basis. So I think the hospital space, at least, one should be a little cautious now, given the valuations have risen there.
All right, Rohit. Thank you so much for taking out time for us. Always good to get perspective from you and hope to see you.